Since Donald Trump was elected president, the average rate of a 30-year fixed mortgage has jumped to a little more than 4%. That's according to Bankrate.com. The day after the election is 3.73%, but if you were looking to buy a home, what does this mean for you? We crunched the numbers to take a look. So if you look at your rate today on a 30-year mortgage, it's going to be about 461.98. That was last week. Today it's 477.99. That's for every $100,000 that was borrowed. At the current 15-year fixed rate, which is what most people use when refinancing, you expect to pay about $700, $773 for every $100,000 borrowed. So last week it was at $689.14. That's an increase. And just remember, these rates are still really low. Until May of 2010, most people couldn't get a mortgage rate below 5%. Now to explain further what this means for you and how to increase your mortgage rates in a good thing and whether it's a good thing for the economy, let's toss it over to Ashley.
All right, as Scott said, we are joined this morning by a mortgage expert, Bill Watson. He's the president of Watson Mortgage Corporation. Good morning, Bill. So to shed a little bit more light, the recent election, why did that cause mortgage rates to rise?
Well, the bond market is done on economics just like supply and demand, and really you had a surge in consumer confidence that the consumers feel that Donald Trump is going to be good for businesses. So you had the demand shift from previous, like with Brexit, where the instability caused people to fly towards the bonds to make sure they got their money back. They now feel that the opportunity is going to be in the stock markets because that he's going to be beneficial to businesses, so they moved over there. In order to continue to sell the bonds that we back the securities with, they had to increase the yields to re-attract demand. That is a good thing because the Fed has projected that they are going to raise rates. When they raised rates last time in December, we almost got even between short-term money and long-term money, which is very dangerous because if they had raised the rates again and the 30-year mortgage rates had not gone up, you'd be paying more for short-term money than you would for long-term money, and that is the first sign of a recession. So this is actually a very good thing that the market is moving, so the rates go up. It gives the Fed room to raise the rates so that if the market does have a stumble, they have another tool in their box to correct it.
So for people trying to sell their homes or people trying to buy, how does it affect them, people in the market?
Thankfully, right now, although it has gone up, it's not been a tremendous swing up at this point. And although you're paying, $15 to $18 more per 100,000 you borrow, it does make a difference in qualifications, but it's not enough to stymie the market. I would say, though, that it is showing that the market's going to be going up and that it's an excellent time to go ahead, and if you're going to looking at refinance or possibly purchasing, I would say that the next 6 months are going to be a prime time in the market to take advantage before they do climb any higher.
That's good to know for sure. And so you're saying this is a good thing. Is there any aspect of it being bad? Like if it continues to go up, is that a bad thing or?
Well, yes and no. I mean, if it goes up too rapidly and too much, it can certainly stymie demand, which can, hurt the market in general. But we have been so low for so long that it really needs to come up at this stage in the game so that we can start moving forward.
Now, if Hillary was to have been the one to be elected, would we have seen the opposite, you think, or how do you think?
I don't know that we would have seen the opposite. You saw how the market dropped 800 points right when it shifted, where the anticipated election did not go the way most people switched it. But then you saw a tremendously fast recovery once they figured out that just realigned which stocks would be mostly affected, I feel.
Any other advice that you'd have for people out there who may be concerned about the rising rate?
Well, I wouldn't really be that concerned about it because it's still so historically low. Yeah. I mean, even
that in comparison, it's...
In comparison, I'll be honest, I've done 2 mortgages where I've been wrong on my crystal ball, once in '99 when I knew the rates would never get below 6.5%, and again in 2003 when I knew the rates would never get below 5%. And I've been wrong both times on that. So the fact that we've been this low for this long, it's kind of amazing. So yes, we do need to get back up to the 4 and 5% so we have a little leeway in the federal funds, because there needs to be some margin to make some money on these.
Well, thank you so much for giving us that input. And we are going to post this interview later today on our website, news4jax.com. If you missed anything, we'll be right back.